We've got low volatility and record highs in risky assets like stocks and Bitcoin, but also record highs in gold. So peaking together all at once is kind of unusual. What does that mean? Is this a bad sign?
Well, I don't think it's a bad sign necessarily. I mean, that's kind of where we are in the cycle today. I mean, gold is kind of, it's a different beast. It's a beast of its own, really. There's a lot of tailwind behind gold because of positioning, demand from central banks, et cetera. And the fact that, yields have been kind of coming off a little bit. Now they're back up. I mean, that usually triggers a lot of demand for gold. But I'd like to pivot a little bit, I think, and talk about something that's a little bit more topical here, which is what's happening in the crude markets. And there seems to be kind of this renewed bullishness in the crude markets nowadays. And I think some of it is justified, based on some of the fundamentals. And we've seen a lot of, positioning adjustment here in the market. But I do want to highlight one thing, which is the fact that one still needs to remain cognizant of the fact that the Fed is still continuing to hike here. And, we've seen one of the steepest monetary tightening.
The Fed continuing to hike?
Well, not continue to hike, but the Fed remains restrictive, right?
Sorry
about that. The Fed remains restrictive here. And, I think that, we've seen one of the steepest monetary tightening campaigns ever in the history of markets. And it's not just that pivot that I'm seeing from the Fed, right? What I'm seeing really is the fact that you got a Federal Reserve now that basically went through a faux pas about a year and a half ago with the whole transitory rhetoric around inflation. So in my eyes, what that's created into the Fed, right? I mean, the Fed is not run by any kind of AI software. These are people, these are human beings, right? And their psychology has been, hit a little bit. So there's a little bit of PTSD in the Fed system, so to speak. So I think that they're making sure that they want to make sure that they attack inflation really holistically. So people talk about CPI, PCE, and try to dissect all of these components underneath it. I think it's a great exercise to do. However, I think the Fed really is not really in the business of doing that, given that inflation is really sticky, right? If you're saying you're not going to be forward-looking anymore, you're going to be data dependent, right? Then you got to react to the data. You got to be consistent with that.
So what does the data in the energy markets tell the Fed? You've got U.S. stockpiles dropping for the first time since January. That's always going to move around, and demand is certainly continues to be a concern if the economy is going to go into this slow descent, not a retreat or anything, but the economy is not going to grow as quickly as it had been.
Yeah, no, I do agree with that. I think what it means is that, the same way we've seen, this Fed put, over the years on equities, especially, from the GFC onwards, I think things have actually been flipped upside down, right? We've got a Fed call option on commodities, right? I mean, I think that if commodities were to spike again, I think the Fed will remain restrictive. If anything, they might hike again. I think that's one of the things that commodities investors struggle today to understand. The reason being is we've gone through about 10 to 15 years where basically, the ZERP policy with zero interest rates. So a lot of investors today, a lot of risk takers don't remember the last time, you had an active Fed. Fed days were non-events in the market for commodities people. If you had a Fed model, you probably haven't run it in a while. It's sitting somewhere in the shelf. Now you got to bring it back to life, trying to spruce it up, dust it off, and trying to make sure that it's up to speed, right? And a lot of people have kind of forgotten about that. We've got a Fed that's really active in the marketplace. You've got interest rates at 5.25% here. And the Fed is really not backing down. I mean, we've got PPI, CPI this week, which is pretty hot. And I think it'll be asinine to think that the Fed is just going to look through this next week, right? Well, I think they'll talk about this.
Well, this has to be a topic of conversation. I mean, we talk about the rise that we've seen in oil this week. I know we're only at like $81 or something, so we're nowhere near those $100 fever dreams we had. But then you look at the jump that we've seen in gasoline prices and some of the other distilled products here. I mean, that has to be a topic of conversation on Tuesday and Wednesday.
Absolutely. I think that, my base case is, I think the dot plot is still showing about 3 cuts for the rest of the year. The market probably, as I was checking this morning, is probably looking at maybe a 10% chance that plots get moved down from 3 to 2.
Well, I've seen that too. But how does that change things for you? Let's say we go Wednesday, we see that dot plot instead of 3, maybe it signals something closer to 2. Does that change your investment thesis?
I think it does. I think that's just going to be a reminder that the Fed is really vigilant about this, and they're not just going to let commodities rip. This notion of because traditional monetary policy usually looks at core inflation, right?
Okay.
Because food and energy tends to be really volatile, so you don't want to manage policy around, something that's super volatile. But this time around is very different, right? The Fed wants to bring inflation down to 2%. Doesn't matter if it's core, headline. They're going full on and trying to bring down inflation to target, right? So if they were to move the plots down to 2, I think this is going to be a stark reminder to the marketplace that they are really onto this.
Yeah.
And any spike in energy prices, any spike in commodities markets just in general would trigger them to come back and perhaps hike again.
If that dot doesn't move, it stays at 3 or even maybe potentially even a little higher than that. Does that matter?
If it stays at 3?
Yeah.
Well, I think that's the base case today. So
Okay.
the reaction function to the marketplace
Gotcha.
is
Yeah.
not gonna be any different than what we're seeing now.
Okay.
I think what's not fully priced in right now is the fact that the Fed could actually downshift to 2.
Gotcha.
Got it.
Yep.
If we were to see that, then I think
Yeah.
it'll usher a lot of volatility, from a cross-asset perspective next week.
So, Frank, you're a portfolio manager, but you're based in Washington, which is kind of unusual. There's not a lot of portfolio managers in Washington,
Yeah.
but you do have access to a lot of policymakers who are thinking bigger picture when it comes to the economy and policy. What did they say about commodities like oil? How are they thinking about it?
Well, the way that they're thinking about it is they're very sort of sensitive to what's happening geopolitically, especially the folks in Washington. As you can see, you've seen Washington being really active in trying to make sure that they're working on the peace, that the Middle East gets some kind of peace deal, with Hamas. So they're clearly seeing a correlation between what's happening in the Middle East and the inflation
action.
picture in the United States. And at the end of the day, that's really the right tail risk to commodities. It's really another geopolitical flare-up that would basically reactivate the right tail of that distribution, and they're aware of that. And that's definitely front and center into discussions in Washington as it pertains to inflation.